Hello everyone, I'm so happy to welcome you all to today's webinar on renewable energy and clean tech insurance. So here we go. India has set an ambitious target of achieving 500 gigawatts of non-fossil fuel capacity by 2030, with renewable capacity now crossing approximately 220 gigawatts. The sector is scaling rapidly. However, as investments increase, so do risks, right? So the insurance plays a critical role in protecting assets, stabilizing revenue, and ensuring project bankability. In this session, we will explore real claim scenarios, risk trends, and insurance solutions available in the Indian context. So, as of 2025, India's renewable energy capacity stands at roughly 220 gigawatts, with nearly 29.5 gigawatts added in the last financial year alone. Solar energy leads to the growth trajectory, followed by wind power. This rapid expansion brings significant capital investment, but also increased exposure to construction, operational, and climate related risks. So, managing these risks effectively is essential for sustainable growth. Some of the key risks in renewable projects are, facing multiple layers of risk. Equipment failures such as inverter faults or turbine blade damage can cause prolonged downtime. Extreme weather events such as cyclones, dust storms, hail are increasing in frequency. Grid compliance violations may lead to disconnection and loss of revenue. Additionally, tariff changes or regulatory delays impact financial viability. So, in certain regions, even geopolitical risks also influence insurance pricing and underwriting decisions. How do weather and climate exposure seen here? So, climate exposure is one of the most significant risks for renewable assets. Extreme weather events are rising globally. In India, also, dust storms, cyclones, and heat waves have directly affected energy production. Production variability impacts debt servicing and investor returns. Therefore, weather linked insurance products, including parametric structures, are increasingly important for stabilizing revenue. So these are the core insurance covers available in India. In the Indian market, several insurance solutions are available. The first one is construction all risk policies cover damage during the build phase. Operational all risk policy protect assets during operations, including machinery breakdown. Business interruption insurance compensates for lost income due to covered events. Third party liability covers external damage claims. The cyber insurance protects smart grid and SCADA systems. Last, the parametric insurance offers faster payouts based on predefined weather triggers. Some of the specialized and emerging covers. So, in insurance, innovation is evolving alongside clean technology. Hybrid policies combine parametric triggers with indemnity based settlements. Reinsurance pools help distribute large risk across markets. Revenue stabilization, riders protect against production shortfalls. With increasing digitization, cyber extensions are becoming essential for renewable operators. Let's look at some of the real-time scenarios. So one of the claim scenario was dust storm, which happened in Gujarat. In a recent case from Gujarat, a 150 megawatt solar park experienced a 12% drop in production due to a severe dust storm. Because the project had a revenue stabilization rider, the predefined trigger was met. The insurer paid approximately 3.4 crore rupees, helping the developer maintain cash flow and protect debt servicing metrics. This scenario demonstrates how structured insurance supports financial resilience. Another scenario here, it's about wind turbine blade damage. So this case involving a coastal wind project, turbine blades suffered corrosion related fractures. This resulting in downtime significantly, which impacted generation. However, the operator had equipment breakdown coverage combined with business interruption insurance. The policy funded repairs and compensated lost revenue, reducing the financial shock. What are the regulatory and grid risk? Let's look at it here. So the grid compliance is another emerging risk. If renewable assets fail to meet technical standards such as voltage right-through requirements, regulators may order disconnection. Even temporary disconnections can result in substantial revenue loss. Insurance solutions combined with strong technical audits can mitigate these exposures. Let's look at this best practices in risk mitigation. So let's say prevention is as important as protection, right? Developers are increasingly using AI analytics, IoT sensors, and drone inspections to predict equipment failure. Early engagement with insurers during project planning improves risk structuring. Joint risk mapping workshops help identify and close coverage gaps before commissioning. So, the renewable energy insurance market is expanding at an estimated compound annual growth rate of 11 to 12% globally. In India, premiums have risen by approximately 15 to 20% in recent years, which reflects in increased exposure and also broader coverage needs. Insurers are developing more specialized products to address battery storage, green hydrogen, and performance guarantee risks. So, what is the future outlook for this renewable energy insurance? So, some of the key takeaways are here. As India accelerates towards its clean energy goals, insurance will remain a cornerstone of project bankability and investor confidence. Hybrid risk transfers model and parametric solutions will grow in relevance. Ultimately, effective insurance is not just a cost, it is a strategic enabler of India's renewable energy transition. So that's all about this webinar, and thank you so much for all. I look forward to your questions. You can post it in the comments. Thank you.